Private equity, an alternative investment class and consists of capital that is not listed on a public exchange. Valuation services. Valuations of business, tangible assets, intellectual property, intangible assets, stock and securities, ESOP and private debt instruments. Financial advisory services. Primarily focused on providing advisory services in the areas of corporate finance, capital structuring, transaction advisory and M&A. Credit rating advisory. Our team's experience can bring in immense value by getting the desired rating upgrades or saving them from downgrades by fine-tuning the strategy. TEV study and DPR report. Evaluating the technological feasibility and economic viability of project to finding out the degree of risk involved. Insolvency services. Assess the financial position of the firm, partnership, LLPs and individuals, in several instances and try to save their business. Training. We are a pool of senior banker, academicians and professors specialized in all kinds of soft skill training. We are specialized in solving your all types of financial needs.
Yeah, good evening, everybody. I would like to welcome to all of you in this today's webinar on a very, very important topic, this co-lending between banks and NBFCs and NBFC to NBFCs, where we are having all the speakers who are veteran banker, the NBFC CEOs and CFOs. Those are the practitioners. Those have participated in this kind of partnership. They have seen the all kind of the situations where what kind of opportunities are there, what kind of challenges are there, and as Resurgent India, we always try to bring the all stakeholders at one place and try to discuss that what are the areas of concerns, so that it can reach to the all stakeholders, including the regulator, and the solutions would come actually. And in this series, they see the I think 142 webinar. So I think last 2 years or 2.5 years, we have organized such kind of webinar on various topics, and there is a great support from the all speakers, the regulator, government, and the audience who have joined us from various segments. So in today's webinar, we have people who are from the banking fraternity. We have the NBFC CXOs, and the other people. We have the rating agency people. We have private equity fund, venture capital funds. Then we have the chartered accountant or other professionals who are having interest in this segment actually. So friends, we will discuss in detail about the co-lending journey till now. And before that, I would like to just brief you that why the need arises for co-lending actually. So first of all, this co-lending, just as a layman, I'd like to just brief that this co-lending is, the name shows, this is the partnership between two organizations, and this is an arrangement where both bank and non-bank come together to lend to a single customer on the I think the common lending policy, where the unserved and underserved customers can get this money at the reasonable cost at their doorstep actually. So this is the thought process behind that. And why it has been thought by the regulator, because you have seen that in the past, last 4-5 years back, there were two big, I think, challenges in the industry. The two large NBFCs got into problem and they defaulted, and the RBI thought there should be some solutions where the dependent on the large book of the NBFC should be reduced, and the portfolio can come directly in the books of the bank. So that's why the thought behind that. And the another thought was basically that the NBFC, which are across the country and they are specialized in their geographies, they can onboard these customers, and the demand is growing, the MSMEs are growing, the other segments are growing, where the priority sector requirement is huge. And the NBFCs are not in a position to meet out this requirement without the availability of the capital at the affordable rate. So to meet out that challenge, this concept came into mind, and the RBI started this concept in 2018 with the co-origination model, but later on it has been converted into co-lending model because there was some constraint in the co-lending co-origination model. So in the overall thesis of this co-lending, the objective of the all stakeholders and the regulator is that money should reach to the underserved and unserved people at the affordable rate, and the NBFC should not face any challenges in terms of the capital availability. Money should be available on tap, so that whatever the underwriting capability they have, whatever their specialization is there, it can be utilized, and the money can come from the larger partner, and the objective can be achieved actually. If we see in this last 1.5 years, the co-lending, I hope that at the end of this 2022-23, there'll be something around 20 to 25,000 crore of co-lending will be there with all the banks and NBFCs. But this is not the end. This is a beginning actually, because for any concept, there is always the teething problems or the learnings. But as we have seen that before COVID, there was something around I think the huge amount of this securitization was there actually. It was more than 1 lakh crore. So the co-lending also, we are thinking that it will take some time, but this will cross the securitization number very soon. So this is an area where we have to discuss and debate and find out the solutions, that what are the challenges, what are the opportunities, and how it can be overcome. So I have just prepared a small PPT which might help you to understand in a structured manner that what are the co-lending opportunities and what are the areas. So friends, because we have all kind of stakeholders, so it is my duty to just brief about the different segments of the NBFC where the co-lending is possible. So microfinance companies are there. Those are giving small loans to the rural people, or mostly the villages, to the women. Then housing finance companies are there. Those are giving money to the individuals for their housing requirements. So in both rural and urban areas. Then asset financing companies are there, which are lending for the various asset classes, so automobiles and the other asset classes, construction equipment and all. Then loan companies are there. Loan companies are like those are in the gold loan, MSME loans, and other thing. Infrastructure companies are there. So all these companies are there, which we call NBFCs, and then the fintech, which is a new addition in the entire ecosystem. So this is the from NBFC point of view, this is the entire spectrum where they fall actually. So if I see the co-lending is possible with these all kind of companies. Just number of NBFCs and HFC and MFI, I think as per RBI data, more than 9,000 NBFCs are registered with RBI. And out of that, some 80 plus HFCs are there and some 90 MFIs are there. And if I come on that number, which is more than 100 crore of asset size, because this co-lending partnership, there should be some kind of, the book is there, some kind of vintage is there. So I believe that this is the pie where the co-lending is possible in the current scenario. So the more than 100 crore size asset size NBFCs are something around 800 plus, and the HFCs and MFIs are even more than 100 actually. So roughly for 1,000 companies or NBFCs are there, those can partner with the banks for the co-lending. The co-lending model, RBI, this came out with the circular on November 5, 2020, with the new circular, which replaced the co-origination to the co-lending. So the broad guidelines of that circular is basically the co-lending is possible only with the all registered NBFC and HFCs. So any entity which is into lending business but which is not registered with RBI, the co-lending is not possible. So that's the important part which need to understand. And this will be whatever the share of the bank and NBFC, it will be booked in their book actually as an individual loan. So it will not be the kind of bulk loan is coming in the bank book and they are booking as a bulk basically. So individual loan account should be opened. Then the minimum 20% share of the entire loan should be in the books of the NBFC, and the rest can be in the bank, in the book of the bank. But the 20% is the minimum for NBFC. It can be 30-70 also. It can be 50-50 also. But minimum 20% is required. Before entering into any co-lending agreement, there should be a master agreement signed between both the NBFCs and the banks. And in this, the entire model, the beauty is that both the parties are having their this independent areas of working. So NBFCs are the sole point of interface. So the front end are the NBFCs with the customers, where they generate the customer, they'll underwrite the customer, they'll onboard the customer, and the bank will provide the money, and then they'll have all the data of the customers in their system. And this was started keeping in mind the priority sector requirement, lending requirement, because as per the guidelines, 40% of the bank loans, total bank loans should be in the priority sector. So many banks are lacking in the priority sector. So the RBI was having this objective also that this portfolio which is coming under co-lending, it should be used for the priority sector purposes. Co-lending, the category of loans basically. So these are some of the examples. So the all MSME loans can come under the co-lending partnerships, and the housing loans, which are under affordable category, a certain size is there. We have our veteran speakers, they'll discuss in detail. Retail loan are there, agriculture loan, and other priority sector loans. The only thing which is not covered actually, the revolving line of credit, so cash credit kind of, or the overdraft credit or non-fund based limits will not be covered under the co-lending model actually. So these are the steps in the co-lending. Whenever any co-lending has to be done, at least these steps should be followed. So we have tried to cover up all these steps here. The first step is the policy finalization by the banks for co-lending. This is now over because every bank has already launched the co-lending policy, and which is publicly available to the on their website, so anybody can know that what is the policy of the bank for the co-lending, and they can understand that whether they are eligible for the co-lending with that bank or not actually. Then the another job is identification, due diligence, and shortlisting of the co-lending partner. So it's like a marriage. So both the partners have to identify the right partner for them. So there is a process which have to be followed. Then so in this identification, there are certain criteria as well which need to be seen. Then the process is the finalization of product. So which product we have to do the co-lending, what should be the pricing to the between the banks and NBFC, and what should be the pricing to the borrower. Then the other commercials, the processing fee and other are to be decided in advance. Underwriting process, so there should be a common joint lending program where the everything should be in the black and white, where how it will be underwrite, what would be the criteria for that, who will do the credit approval, and how the sanction letter will be issued. So as per the guidelines, I think the single sanction letter will be issued to the borrower. So although the two entities are lending together, but the borrower will have the single sanction letter. There can be logo of the both the parties on that sanction letter. Then finalization of master agreement. So there is a master agreement which covers all the clauses about this arrangement, which need to be signed by both the parties, and this should be carefully seen by both the parties before signing. Technology, I think we are talking of digital lending, and also technology, one of the area which need to be discussed in advance and worked out, so that what technology will be used and how it will help to the entire co-lending process. There are escrow accounts mechanism where all the co-lending should be done through the escrow mechanism, where the escrow collection or escrow disbursement. So this is some kind of technical where we have to keep in mind that without escrow account, this co-lending cannot happen. And the collection of who will collect the portfolio. So NBFCs are responsible to collect the money, and tracking of the portfolio, customer service, this SARSAI and the mortgage charge creation in case of secured lending, post disbursement records where the records will be kept so that both the parties should access of the records, NPA recognition. I think now this IRAC norms, both banks and NBFC are at par, but earlier this was a challenge. Then the reporting and the business continuity plan. I think this is a very important aspect. Whenever you are identifying your partner, we should keep kept in mind whether this partner has the continuity plan, or what is the future of that partner actually. Because once you entered in the partnership, who will serve that customer if any of the partner it got into problem actually. The cancellation of contract and the foreclosures, repossession of assets, all these areas are there. Taxation is one of the area which is still evolving, where I think direct taxes, both direct taxes and indirect taxes, there are some differences between the banks and the NBFC policies which need to be addressed also. So these are the areas. Looks very small in these lines, but I think these are the areas which need to be discussed in detail before entering into any co-lending partnerships. So advantages, the banks are having many advantages. They can cover the untapped market. They can do the digital lending through that process. Priority sector book, which is the major pain area of the banks. Low cost of operation. So there is no cost as such for the banks in terms of operation costs. So they'll save in the operation cost, and they'll have the better margins also. And cross-selling opportunities. So the banks are doing many products and many services. Rather, NBFCs are having the only one product of lending. So the banks can use that customer for many other services also. So they can multiply their revenue from that customer. Then the financial inclusion, the government is behind all the banks for financial inclusion. Better utilization of surplus. So a lot of surplus is there in the banks. As of today, it is not there, but some time back. So the surplus can be utilized in a better way. No sector exposure cap for NBFCs. It is a big challenge. I think most of the banks are full of the sector exposure cap. In case of co-lending, there is no sector exposure cap is there. Better collection efficiency. If we see the numbers, the banks or in the banks or NBFC, the NBFC's collection efficiency is far better than the banks in some cases. NBFCs, this is a asset-light model for them. So this is a major advantage that they require less capital. They can utilize their capital in a better way. Funding constraint, I think every time whenever they have to lend, they have to go to the banks or other institutions for raising money. If they have a co-lending partnerships, they are not required to go everywhere and to ask the money, but the money will be available on tap. Access of better credit profile, because when they are tying up the bank, they can reduce the lending cost to the borrower, so they can have the access of the better customer, and their AUM can grow. Then the fee income growth, so practically they'll get the fee income, and which will help them in the better valuations also from their investors. Less credit risk, because banks are also taking the risk on their portfolio. So there are many advantages to both the partner, both NBFCs and banks. They have to see that from their point of view. These are some of the parameters whenever any tie-up is to be there, that most of the banks policies are saying that the A rated should be the minimum eligibility criteria for NBFCs to become the partner with the bank. But some banks have considered BBB also. So we have to see in advance that what is the policy of the bank. GNPA, any NBFC who is having more than 5% GNPA, banks are not very comfortable to partner with them. Even NPA should not be more than 2%. And the vintage, minimum 3-year vintage is required. Then some other covenants are there, the profitability and other things, which need to be seen in the policy of the bank. These are some of the areas in terms of commercial. So these need to be discussed and decided in advance before entering into the co-lending master agreement. Interest rate, what will be the interest rate between both the parties, and what would be the interest rate which will be charged to the borrower. And you see that interest rates are also floating and the fixed rate. So who will charge floating, who will charge fixed, or whether both will charge the same floating or fixed. So because the entire the combination will change. So this should be decided in advance, and how this will be reset also. Processing fee, who will keep the processing fee, whether it be divided partially or it will be 50-50 or it will be 0-100. So these are the foreclosure charges, because in the loan cases there are foreclosures also. Who will keep these foreclosure charges? What will be the foreclosure charges? Penalty in case of delay repayment or all the penalty, bounce charges, insurance charges, documentation fee. So these are some of the commercial areas which are to be decided and discussed in advance, and there should be clarity, transparency, because any arrangement, any partnership, it will go long when we have the transparency in all these areas, so that there should not be any debate or discussion later on these areas. Challenges. So when the opportunities are there, the challenges are there also. So the common credit approval standard, I think both the banks and NBFC should come on the same platform, where most of the NBFCs are working on the informal income kind of borrower. So the bank's credit policies are based on the profitability and the balance sheets and all, income tax returns, and also these areas need to be addressed. Banks are more flexible now. They are having the product committees which are evaluating the NBFC's policies, and they are trying to align with the banks and NBFC policy and to go for this co-lending partnerships. Fluctuations in the policy. So banks are governed by the regulator, RBI, and even NBFC are governed by RBI, but the policies are a little bit different. So whenever the policies are changing, how it will be adjusted in the entire co-lending process. This should also be discussed. Accounting challenges. In the past, with our experience as Resurgent India, because we are helping both the bank side and NBFC side on the co-lending, we are seeing that some of the accounting challenges are coming in the discussion, which need to be taken care and it should be, I think, discussed in detail, so that there's not be any challenge later on to both the parties. And integration of the technology, which is a very, very important area. So some of the technology partners are there; those are providing this technology, but still there is a I think requirement to have the better technology in this area. Then the bureau reporting, hypothecation, these are the again areas which are still having some kind of discussion requirement. So friend, this is brief about the co-lending model or co-lending process, which I try to cover up, so that we should know that what is the background in this co-lending this thing. Now we have speakers or the panelists who are veteran, who are, I think, having experience of more than decades in their journey in the banking or NBFC space. So I would like to invite them and we'd like to understand from them that in the practice, what kind of opportunities or what kind of challenges they have seen. So we have Ms. Sonia Chhabra Gupta ji. She is the Chief Business Officer from Balance Hero India, this True Cap, I think company name is True Credit. And she had very vast experience on the banking sector, the NBFC and the other areas also. She was with some large companies and she is deeply involved into this. So first of all, Sonia ji, I would like to welcome you in this webinar, and we are very thankful that you have given your time and you are interested to discuss with our audience about the co-lending part. So we have some questions for you. So the first question which we would like to understand from you, or that is, what factors should banks and NBFC consider when selecting a co-lending partner to ensure a successful and mutually beneficial collaboration? So although I've tried to cover some portion, but I think you can cover in detail. Whenever both the NBFC and banks are selecting the partnerships, what factors they should keep in mind to be successful and therefore beneficial for both of them. The second question is that how can banks and NBFCs strengthen their co-lending partnership? One is entering the partnerships, another is strengthening the partnership. Actually, entering is easy, but strengthening it is also so like it's a marriage when you somebody got married. But how to keep that marriage relationship successfully for long term, that is important. So I would like to invite you for your deliberation, Sonia ji, and over to you.
Thank you, Ashish, and I'm very happy to be here. And in the interest of time, let me quickly, get down to answering that question. Co-lending is often, and during this conversation itself, we've referred to it as a marriage, right? A couple of times. But I think someone very rightly pointed out at the beginning of this discussion that it's just not a marriage between two people. It's actually you're getting a ready-made family, right? And hence the challenges are manifold. So I think, the guiding principles of a successful partnership in my mind would be four. One is intent. Both parties have to be equally intent. The relationship, alignment, trust have to be there. So some of the things that need to be considered and kept in mind is the alignment of vision and goals between the two parties. And this is even more challenging when it is a bank to NBFC than NBFC to NBFC. For any partnership, it is crucial that the vision and the business goals are aligned. The entities need to be on the same page with everything, whether it is the customer segment, the product, the risk, pricing, roles and responsibilities, compliance requirements, etc. The second and very important one, again going back to the getting together of two families, is to actually find the best symbiotic fit. Both parties have to be equally convinced that this relationship will be mutually beneficial and will fill a need gap that they may have. Right? Only then will they be able to devote the required time, management, bandwidth, and the resources that this would require to be a success. If any parties have to compromise on institutional goals or vision, then it can never succeed. The third and very, very important part, and I'm, again, it was touched upon in the presentation, but this cannot be kind of emphasized enough, is the technology platform and the ease of integration that the two bring together. Because at the end of it, this is the core, right? Marrying the two LMSs or the two systems, and hence the maturity of the partner ecosystems to allow for thorough integration of data sources and processes is in somewhat of paramount importance. Seamless and efficient integration is necessary, and it requires, clarity on the capabilities of both systems, on the customizations that may be necessary, and on any limitations that exist, and they will exist. But before you actually go into the partnership and start the development, else it can just become a never-ending whirlpool of issues. And more than anything, both partners, there is no one size that fits all in this. Hence, it's very, very important for both partners to have a agile and flexible development mindset. I think this is something that if this is something that exists, a lot of the challenges during and post will be taken care of. The next, and again, it was touched upon, is the risk appetite, right? And the capital, the ability to fuel the growth of the fintech or the NBFC. One of the primary reasons why banks or NBFCs and fintechs enter into marriages is that, beside the obvious advantage possible, digital platforms, etc., is to expand distribution to, be able to get insights into customers, segments that they would otherwise not normally have served, to improve their product portfolio mix, and of course, for better efficiency and lower operational costs, right? However, very often they are unable to accept or appreciate the nuances that come with these different customer segments, which the partner NBFC or fintech, may be targeting. And when that happens, there is an obvious mismatch in the risk appetite or their ability to serve it. Hence, it's imperative that they appreciate it, they buy it, and they have the risk appetite and the required supply of capital, not just to start a partnership, but to continuously and constantly fuel the growth and scale it. And last, and of course, this is supplemented, this has to be supplemented by commercials that are viable and make sense for both partners. If anything is one-sided, it's not going to, work. The last, but definitely not the least, and I think one of the most important pillars of a successful co-lending partnership is, the transparency and communication. The hallmark of a successful, scalable, long-lasting partnerships is properly structured models and watertight SOPs. Right? All processes, handshakes, responsibilities, data ownership, transfer, payment terms, conditions, liabilities, etc., need to be clearly spelled out and agreed to before the commencement of the business. And in fact, one of the key factors that often gets overlooked is the need for timely reporting and robust MISs. Right? This is the only way to build trust, ensure accountability, and to grow together to achieve scale. So while there's tremendous opportunity in collaboration, in co-lending, there are significant, obviously we all know business, legal, and regulatory challenges. And the key to success will be in balancing, these operational considerations along with compliance and risk considerations. So I think those are, some of the key pillars that I would say is an essential requirement for a marriage to work or a co-lending partnership to work.
Thank you very much, Sonia ji. I think you have very well covered. You have given the guidance to us also. This robust MIS, which is one of the area which I think has come in the discussion, that if the MIS is perfect and foolproof, then definitely this marriage can go long actually. So thank you very much. Thanks for your suggestions also. Friends, now we have another veteran from the industry. This is a well-known name also, and we had signed this co-lending agreement very recently also. So I would like to invite Himanshu Gupta ji. First of all, congratulations, Himanshu ji. You have just signed the co-lending partnerships with one of the leading banks. So first of all, welcome to you. Himanshu ji, we would like to, Himanshu ji, the director and CEO of a company called Moneywise Financial Services Limited, which is a NBFC, and it's a very old group, SMC group, and he had vast experience of the financial sector. So Himanshu ji, we would like to understand from you this: what role can industry players, policymakers, investors, and consultant and technology providers play in advancing the co-lending industry in India? Because it is at the very beginning actually, you see, this has to go long actually. So how all the stakeholders can play the important role in this. And another question is, what are some expected future trends for co-lending in India, and how can banks and NBFC capitalize on them to achieve growth and success? So these are the two questions which we like to understand from you. And if you can highlight your journey of onboarding of with the bank recently, which you have done, how was your journey, how smooth it was, so that the other people who are aspiring to become partner with the bank, they can get some idea or some clue from that. Over to you, Himanshu.
Okay. Thank you, Ashish ji. First of all, it's my pleasure to be part of this discussion. And good evening, everyone. So before I come to your question, so let me introduce a little bit what we do. So we are majorly lending in the SME space by way of unsecured loans and loan against property, equipment loans, and various other products that we do. So the idea that came to us, like obviously, like co-lending is one of the hot topics since last couple of years. So we have recently tied up for the loan against property product, wherein we felt that the banks would never lend to an NBFC for 10 or 15 year kind of tenure. which usually happens in case of mortgage loans and the home loans that that others do. So that is a wonderful regulation that has come up, wherein the NBFC, which has the last mile reach to the customer, and the bank, which has the low cost of funds. So that is a wonderful proposition. Regarding our the recent tie-up that we did, so one which we recently tied up, so the journey was quite interesting. The bank were very open for the discussion, particularly coming to the policy part of it, wherein we thought that, as Ashish you said, that banks have like their own reservation how to underwrite to a particular customer, while NBFCs are lending to the customer who does not have the proper financials. So banks have now realized that they need to adopt the NBFC policies as far as the co-lending tie-up is concerned. So the bank are pretty flexible, and the process was quite smooth. So it takes longer time to onboard with a PSU bank, so that is okay. Going forward, I believe this co-lending product will the borrowing for the NBFC would shift drastically from the term loan, which is the major source of finance for all the NBFCs, to the co-lending model going forward, because the banks have their concentration norms in terms of the term loan that they can provide to the NBFCs. And co-lending, there is no such limitation. So I think going forward, the borrowing mix is going to be inclined towards the co-lending, and it is going to grow at a very large pace, very fast pace. And the role which I think all of us can play together is we need to put up the whatever challenges that we are facing. So we need to convey it properly with very, very much clarity to all the regulators. I think that is the best role what industry and all of us being stakeholders who can play to promote this co-lending. For example, like there are still some gray areas as far as practical implementation of co-lending is concerned. Like, just to give you a few examples, the TDS is still one area which needs to be clarified, because the customer has to deduct the TDS for the NBFCs, while banks are not subjected to the TDS deduction. So as of now, NBFCs have to bear the entire burden of the TDS. Obviously, it is creditable while paying the final income tax, but still, from the cash flow point of view, there is a cash flow which gets blocked immediately for the NBFC. So that needs to be addressed, I think. There are certain other clarifications which are needed. For example, for the foreclosure charges, there might be some gray areas whether the NBFC can charge foreclosure charge in certain situations and things like that. So I think what best we can do collectively, we can, I think, do proper representation to the regulators, and this is going to grow.
Right, sir. Thank you very much, Himanshu ji. I think one is the TDS and the foreclosure charges, the two areas you have given. So I think these can be settled when the journey will go further, actually.
And I think there are certain schemes which are like, there are certain guarantees which are provided. There are many schemes which are offered through banks or through NBFCs. So all those schemes need to be aligned, because there are certain schemes which run exclusively for banks, and some schemes run exclusively through NBFCs. So I think there has to be some point of like they should converge ultimately, so that those schemes can be run through co-lending model also.
Okay. Great. So thank you very much, Himanshu ji, for your deliberation. And you told that your journey was very smooth. I hope so that in future also the partnership will be, I think, smooth for you. And we wish you all the best for this partnership. So thank you so much. Friends, now we have a very senior banker with us, and he's a well-known name. We have Partha sir. Partha sir, he is the former MD of IOB, Indian Overseas Bank, and he turned around the bank and from PCA to a profitable bank. And before that, he was DMD of SBI, which is the largest bank of the country. And he has done many things in the SBI, and he was instrumental in many areas to convert or to start the innovate many things also. And here in IOB, in Indian Overseas Bank, sir has done many things in the co-lending side also. And we have seen the growth of the IOB. And it is our privilege that sir is with us, and he has given his consent to be the part of this panel. And it will definitely help us to understand from the bankers' point of view how they think from their side on this co-lending model, because they have seen all the banks' process and systems. So, sir, first of all, I would like to welcome you and thank you very much for joining with us. And would like to understand from you on 2-3 areas. So the one is that what are the issues surrounding loan pre-sanction in co-lending, and how can they be addressed? So the pre-sanction at the time of pre-sanction, what are the issues which are to be considered, and how they can be addressed? Another area is that how can banks and NBFCs ensure co-lending arrangement that it is transparent, fair, and free from any challenges, the wrong lending practices. So, sir, over to you, and thank you very much, sir. Hello, sir. You are on mute, sir.
Yeah. Good evening. Thank you, Ashish.
Yeah, thank you.
So, as from the banker's point of view, I think it is a very, very extremely good model. If we want to increase our credit portfolio in the priority sector, because you see, for the banks, 2-3 things are absolutely necessary. Number one is that you have to comply with the regulatory prescriptions regarding priority sector lending. Number two is that financial inclusion is now one of the most important or focused area of the government of India, and as PSU bank, you need to implement it. So these two are the major drivers, and co-lending process is a model whereby each one of us is just trying to leverage the other strength. Now, if you look at what are the other strengths, so for the banks, the strength of the NBFCs are, number one, they have a much wider outreach compared to the banks. Number two is that their credit process is quite faster if you compare with the system that are being followed at the banks, because these are all legacy problems which we are still continuing and need to revamp and change a lot. Gradually it is happening, but definitely the NBFC, especially the new ones, which have come with a lot of robust technology, they are quite ahead in this front in selecting the customers and making quicker decisions. The third is the collection mechanism also. If you look at the collection mechanisms, I feel that the NBFC's collection mechanism is, I would say, is much better than that of the PSU banks. There are many reasons behind it. And the first major thing is that you see, as a PSU bank, you cannot have the time because there's so many things you have to do, the recovery and follow up everything. The adequate time is not given. So that definitely we can take the strength of the NBFCs in this regard. And for the NBFCs, the greatest strength is that their resources, because banks have almost, I can say, unlimited resources, huge deposit base, huge liquidity, and getting a direct loan for the bank and then again on lending it for some purpose is a time-consuming process, requires a lot of credit appraisals, requires also the sector-wise, also the segment that should not be breached. So many other criteria are needed, which can be obviated if we go through the co-lending model. So co-lending model, I can say, is definitely one of the best models that RBI has introduced. And there are definitely certain initial hiccups. The initial hiccups, the first thing is that if you look at the model, so first criteria is that the bank and the NBFC board should have a board approved policy. Now the synchronization does not come in this policy making only. So if you can remember that in IOB also, we started with some policy. Then we found that the business is not coming because it is not synchronized with the trend in the market. And then we subsequently made the amendments, and then only we can get the business from the NBFC. So that is very important from both sides, whether it is from the bank side or whether from the NBFC side. And now the selection, and in this master policy also, or the board approved policy, I think it is better to have a round of discussions with the various banks, because with the banks you can already have a discussion, and both the banks and the NBFCs can let down the basic principles of selecting a borrower. These are very, I would say, poor people, or they are, I would say, the most needy people who do not actually have the courage also to visit a bank branch, but they are being marketed by the NBFCs. So we should have a very simple risk analysis model. The risk mechanism model should be very simple, based on their track record, based on their CIBIL scores. Many of them may not have also CIBIL scores also. So that also we need to obviate for that year. So it's obviously based on their track records and based on their experience, we need to devise a proper risk model so that at the first sight, when you are taking up the proposals, the borrower is accepted to both the banker and the NBFC. That simplification is needed. What we find is that in many cases, we are unable to grow, our bankers are not able to disburse the funds because bank's criteria is quite different than that of the NBFC criteria. So we need to synchronize on this front so that we can have the NBFCs right from the beginning and their borrowers right from the beginning, and we can smoothly process the loans and disburse the loans. That is one which is absolutely needed. The second thing I would say is that there are certain issues between the banks and the NBFCs, and the most important is the technological synchronization. So each bank has its own systems and softwares, each NBFC has its own systems and softwares. So integrating these two systems is definitely a challenge. So till such time, I would say we can go to the second model, that is whereby we can fully buy out the assets of the NBFCs, and NBFCs can sell their assets. And so the second model, which is almost similar to the securitization or the direct assignment, that is more important, and we can go through it and we can push this through before we can come to the first model where a sharing of the loan can happen, because that has some challenges. Yes, definitely. One is the PDS challenge, where the NBFC has to give, the banks don't have to give. Number two, the appropriation of the various charges, that is also a challenge. And more so the data sharing through the two systems. It should synchronize and it should come a common data for both of them. So works are going on. I think now everyone was just saying that CLM2 has found out some solution in this regard. So going forward, we can also think that yes, we can have a proper technological solution to this process. But till such time, I think the second model of full financing or second model of direct assignment that we should promote, because the minimum holding period is not required. And in this, through this model, we can actually promote the co-lending model for that year. And as you have said, the 25,000, the market is much more. It will soon beat 1 lakh crore. I have no doubt on it, because now all banks are participating. As I've told, that they need to fulfill the regulatory prescriptions, and they need to also support the Government of India financial inclusion drive. So there is an ample opportunity for both of us. It is a very profitable model. And to the borrower, the best thing is that their one point contact is the NBFC, but they get the benefit of the blended interest rate. That is because the bank's interest rate are definitely less and the NBFCs, which are comparatively more, but when they're blended, it is an advantage to the borrower. So it is a win-win situation for all three of us. That's all. Thank you.
Thank you very much, sir. Very well said. And I'm really very happy that you have covered all the aspects as a banker. I think you have given that hope that it will reach 1 lakh crore very soon, actually. So that's a great hope to the industry. Because as a senior banker, we have seen from that inside that what are the opportunities and how the bankers are looking for, actually. So the industry will get this benefit. I think as of today, this NBFC overall industry something around 32 lakh crore, actually. And out of that, the bank borrowing something is 13 to 14 lakh crore, actually. This is the number. So I was reading some, I think some article somewhere in the newspaper. It was written that within 5 years, it will take the 30% pie of the bank lending, actually, this co-lending. So not 1 lakh crore, it may be more than that also, maybe 3 to 4 lakh crore, actually. So this is a good opportunity for all the banks and all the NBFCs. Technology is one of the area which you have already, I think, touched upon. But I think it's a matter of time. Whenever the need is there, the technology will also come. And the people will also geared up for that, actually. So this will also be solved very soon. And the ultimate objective of the government, that private sector and giving the money to the unserved at the reasonable cost. This is the core of the entire co-lending model, which will be, I think, achieved with this co-lending. And we hope that all the stakeholders will get the advantage of it. So thank you very much. Thank you very much once again. And one thing which you have touched upon, really, you are very honest and candid that the policy which you have prepared and somehow it was not matching with the market and all, and you accepted. We have, as Resurgent India, we are giving the complete landscape of the policies of the banks, and then you have understood and you accepted and you have directed to your people that it should be corrected. And I think you have done the better than the others also. So this is really a great thing as a leader. I think these things are important. Every leader in the either in the NBFC or bank should understood that what the market is needing actually. We should not be in the silos actually. Then this co-lending can be the successful model for everybody actually. Thank you so much once again, sir. Friends, now we have another veteran from the industry who had worked in the various organizations, in the large organization like Tata and all, ICICI, Tata, and now he is working in an organization which is helping to the poorest of the poor, or the low bottom bottom of the pyramid for their business loan requirement. We called it micro. There in MSME there is the word micro actually, the first time. So we have Mr. Mayank, who is the CFO of the company called iFinance. They are meeting out the requirement of the people at the lower level for their business requirement, and he has very vast experience of the NBFC space also and the banking space also. So first of all, Mayank sir, Mayank, thank you very much for joining with us, and we welcome you also. And we would like to, we have a lot of understanding about the NBFC space. And before this starting of the session, you were talking about the different aspect of the co-lending also. So we have some questions we'd like to ask from you. So one is that how to overcome operational challenges in co-lending programs for successful collaboration between lenders. That's the first question. And another is what are the key factors for successfully integration of technology between banks and NBFCs, and how to manage them effectively for seamless collaboration. So if you can cover both these questions, it will be great. And
I think in the current context, both are correlated because more operational challenges are from the IT side. So, and there is an overlap because now everything has to be digital. So you can't share a physical file with the co-lending partner for them to underwrite. So since we are in the process of going live, and it has been a rocky way for us. Things go back and forth. Operationally, what we saw is bankers do have a difference of opinion on the way we operate or the segment we operate in, because they might not even have seen those customers. like there are basic things where we have to explain to them why we do this. And the point which Mr. Pratim had, Singh Gupta had said on the CLM side, see, there's a bit of dichotomy that in CLM 1 we are expected to do a weighted average pricing, but in CLM 2 that is not possible, because if I've already onboarded a customer, I can't do a weighted average pricing now, because the banker might decide not to take the loan. I won't give so if the pricing is 20 and weighted average should be given 14, I would not give a 14% rate to a customer and then decide the co-lending has not happened and I will price accordingly. So there is a difference which is there. And that's why we would prefer to always do a CLM1, but the challenges on the IT and operations are very, I would say, magnified when we go on CLM1. CLM2 operationally is quite good, but eventually it is not giving any benefit to the customer, because NBFCs would not charge lower knowing that it will give the pricing subsequently from the co-lending. So that I think somewhere RBI will have to come up with more clarity. How do we do that? Because it will finally have to be passed on to the customer. It's like DA. I have already sourced. I would not reduce the pricing just because the case went under co-lending. Other is on the sharing of charges. Sometimes bankers feel that we are charging too high rate, too high charges, because the intent is to reach out to the customer of theirs. But I, as an NBFC, I would not change a policy. So operationally, it becomes difficult internally to sell the product. Forget getting the policy approved, even the commercials to share a particular fees, because OPEX is ours. So why should I share a fees? So basic questions like those pop up. So, but fortunately, the partner we have selected, we have been able to have very positive discussions with them. And I think on the PSU side, that is going to be a challenge, whosoever does the discussions with PSUs, because over there is a bit of bureaucracy. There would be some challenges where they would be accepting few things, and they will have to go back to their committees, to boards to change. And it's a very long driven process. So for a private sector bank, if we have taken 6 to 8 months to actually go live, for PSUs, I can expect this can be a year or 1.5. And I think on the IT side, private sector banks are little easy to navigate. We have not as of now gone on PSU side, but I expect that is going to be a much bigger nightmare for us. But surely it is a very good opportunity for us as well as on the customer side, that under CLM1, they would surely get a benefit. On the operating other thing which comes to my mind is basic things like a check presentation. It is very difficult for NBFCs to change their way of moving. So I can present a check, but expecting a NBFC to actually collect cash and only deposit those many customer cases in the bank account or the escrow account. So there will have to be some clarity in writing to be given by RBI. It cannot happen subsequently that the RBI comes and says ki you are not allowed to deposit in your main bank account, but you have to deposit in the escrow account. So those clarities or those FAQs will have to be clearly mentioned by RBI, because that becomes a concern.
Thank you, Mayankji. I think you are very straightforward, and I think the questions, the suggestions which you have given. So, but I believe it doesn't matter whether private bank or PSU bank. The market is big, so it's up to you that which partner you want to select. Actually, every partner has its own advantage and disadvantage, or the opportunities and challenges also. So whether it suits to you, the private bank, somebody will be happy with the PSU bank. So depend on the choice actually. And
from happiness, we would be happy with PSU bank, but the question was on the operational issues and technical issues. I think that will be much more in PSU banks rather than on the private sector banks.
Maybe correct at this juncture actually, but I think now the PSU banks are also gearing up, and they have towards policies, and as I told you that this partners are. Whenever we approach them, we have told them that this is the market, the other banks are doing like this. He has immediately corrected it actually, and he did better than that actually. So somebody has to knock the door actually. That is important. So people like you and the other people, we should, I think, regularly interact and try to knock the door that what is happening in the market. So they're also open. Look, everybody needs business actually. So that is important. Regarding your this sharing of charges and all, this depend on the business. Commercials actually, everybody has its own commercial process, or cost of money actually. So according to that, it will be decided. Thank you very much. I think you have candidly told and straightforward, given your views actually, that is very, very important so that others should know and it should reach to the industry also. Thank you very much.
Thanks for giving
Thank you,
the
sir. Thank you. Now, sir, we have Rohit Chauhani ji. He is the MD of AG Home Finance, which is a housing finance company, but it is a fintech also. They are doing many things, and it's a very tough that in housing finance you are running like a fintech and doing the co-lending also because it's a very long gestation kind of asset where they are lending 15-20 years kind of lending to their borrowers. So first of all, Rohit sir, thank you very much for he has very vast experience in different areas. He is also investor in various other businesses. So I would like to welcome you, sir, for joining with us, and we would like to take the benefit of your presence. So there are some questions which we would like to just understand from you, and then you can cover up from your company point of view, basically how the AG Home Finance is helping the entire affordable housing segment. So the first question is, what are the key steps to developing a successful product strategy for a co-lending platform? So what should be successful product strategy? The product is more important. Then what are the strategies for aligning underwriting models in co-lending arrangement to manage risk and ensure successful partnerships? So risk is another criteria where both the partners are buried. So how it can be underwritten in such a manner that the risk would be minimal and it can be a successful partnership for long term. So over to you, and thank you very much, sir.
So thank you for having me today, and a very good evening to all the participants who are participating today. So it has been quite a fruitful discussion with all the other panelists, and I would summarize these two questions in this factor. Firstly, that as a company, we are only in the PSL affordable housing loans, which is less than 30 lakh rupees. And we are tackling that problem where you're servicing tier 2, tier 3 and tier 4 cities. So it's a different angle. And on top of that, everything is absolutely on a mobile app. There are no paper forms. There's no human intervention as per se. So it's a very different way of lending in the secured home loan business. In terms of co-lending, we have had multiple integrations. We've had integrations with a very large housing finance company also. We've had integration with a private bank also. And soon we are starting an integration with another public bank also. So we've had a gamut of integration. So there are some experiences I'll share and I'll answer those questions. So firstly, in terms of the product strategy, we have to, like my co-panelists have mentioned, we have to divide it into CLM1 and CLM2. In CLM1, the basic fundamental is that you have to get your LOS right, your loan origination right, because your LOS systems have to be integrated because you're underwriting together instead of underwriting later. So you have to get your origination right. And while in CLM2, you need to have your LMS right because you're doing it after you have already disbursed the loan as an NBFC or an HFC. In the CLM2, you have only two criteria, which is your KYC criteria and second is your product fit criteria. So if you get your rule engine right, what the bank wants as a product, you will ace the CLM2, right? And even in CLM1, you have to understand their underwriting style, that what their underwriting style is, and you have to align your underwriting style with their underwriting style rather than trying to impose your underwriting style on the bank. So for a successful partnership, if I would categorize, you have to have a policy alignment, which is absolutely critical. And policy alignment simply means is what the bank expects versus what you want. Second is you have to have an accounting alignment, accounting process alignment, that when the money will come in, when you will provide, will it be on T+0, T+1? When would you amortize the money and how would you take it forward, right? Third is the servicing alignment. Servicing is simply that how will you collect the money? Will it be directly into the escrow account? Will it be only through NACH, ECS? Will checks be presented? If there is a T+2 issue happening, then how will that be treated? Would that be treated in the DPD or no? And then post facto disbursement servicing alignment is that where, how do you, if you take it to SurfaceC, then who will be the initiative of SurfaceC? How will be the legal cost? divided. So all those things are covered in the servicing agreement, right? That's the servicing alignment. The fourth and the most important aspect is understanding the product requirement of the partner, that what product does the partner want and how do you integrate that product. So if the partner wants only urban home loans and no home loans in tier 3 or tier 4, then you have to have that product alignment. You cannot have, like, for example, if you tie up with a bank which has only, say, maybe 500 branches. So maybe the bank will only want to operate in those 500 branches and your overlapping is not there. So that has to be fixed at the primary goal, right? So these are the things to answer your first questions. On the second question, the risk alignment between both the HFC or the NBFC and the bank or the non-bank, you have to get your rule engine and risk determination engine right. This simply means is take all the policies of the bank, align it with your policy and put it in your own product rule engine, so that when the file goes to the bank for underwriting, it is already underwritten for the bank. So they only have to see it rather than actually wanting to approve it, because that will slow down your process and you might lose that customer. The second important factor is get your compliances right. That compliance is simply as simple as KYC compliance. You have to get your compliances right. Third is the area and geography categorization of the customer, which areas you want to go, which geographies you want to go. Because that also determines for the risks. So certain places the bank would not want to lend, right? And that will, again, you have sourced the customer and you lose the customer. And majorly you have to get the underwriting style and information alignment. So basically the underwriting style, how they want to underwrite it or how they have been underwriting it. So their information you have to provide, that however their style is. If you try to impose your style at the starting of the arrangement, it won't really work. So you'll have to take their criteria also of underwriting. And one tip which I would like to share with everyone, which really worked for us, whichever bank or whichever non-bank or HFC you want to work with, first do a direct assignment with them. As soon as you do a direct assignment with them, you will actually know the exact product criteria, what they want. So because the portfolio that they will absorb, you will actually know what the credit criteria is. That will be the single issue, how your entire risk will be sorted out with the co-lending partner. So that's my take on the co-lending part. And I feel that we are just at 1% of the total potential. I feel there's a very long way to go. And a lot of technology is going to be used and is being used. So it's an opportunity which is unparalleled. And I mean, the government getting this and the RBI getting this is one of the best things that has happened for the end customer. That at the end of it, it's a nation building exercise and we should participate wholeheartedly into this. So that's my take, Ashish ji, on this.
Thank you, sir. I think you are very well covered and very crisp also, and I think you have covered all the aspect. The last one which you have told is we have to do DA with the bank, the same bank, whenever you want to do co-lending. But there might be some, I think, challenges, because DA for DA the policy, whatever the policy there, which I think might be different, and for co-lending it might be different. So whether you want to do DA will fit in their criteria or not, I think it may be a challenge. But I believe it should not be the only way of doing co-lending, because what I have seen as practitioner in the NBFC space, for DA banks are having stringent criteria in terms of this eligibility. I think they ask AA kind of this thing rated. In case of co-lending, they are still okay for BBB rated NBFC. So then the portfolio size and all these things are there. But wherever it is possible, it's a good suggestion where if you can do the DNA. So this is like that you have entered in that house and you know that ghar ka mahal kaisa hai. Then you are doing marriage. You are giving your daughter to that basically. So that's good actually. But thank you very much covering all these aspects. So the major objective is that, because any partnership will go long only when there will be a smooth journey. A risk with both the partner will see that the money is important of both the partners, then the risk will be minimum actually. When the risk will be minimum, it will go long. Because what I believe is a journey which I just started. and there will be the speed breakers which will come. But once the speed breakers will get over and the portfolio will behave very well, the banks will also encourage to go in a big way in this co-lending partnership, because it's a win-win for both of them actually. So thank you very much for covering this aspect, and I believe all the speakers have done wonderful. I think from their side, they have given their views openly and frankly, where they have tried to give the practical aspects of their journey also. So this will be helpful to all the participants. So we had more than 100 participants. Those were live here, and there more than 500 participants who were live on the other YouTube channels and the other social media channel. So it has been, I think, widely spread, where people have listened us and they will take the advantage of it. They will connect or they will contact all of you also for knowing more about the co-lending, this thing. And there are some questions which have come from the audience. So this one question, which is, I think, very important also, who reports to bureau? Will it be both or originator? If both, then the report is in the ratio of the loan amount. So that somebody is asking this, Barun Parekh is there, he's asking that who will report to bureau basically? Both the parties will report or single party will report? So can somebody take this question? Because this is a very relevant question actually.
As per the guidelines which have been shared, both will have to report for their ratio of the loan. And another technical challenge is that because RBI or the bureaus expect us to straight away push the data from LMS to the credit bureau. But if that has to be done, LMS will not be configured like that it will identify the case and put 75%, 80%. So the requirement is there, you both have to do, but it's a reporting challenge.
But in this case, Mayankji, suppose 100 rupee loan has been given and both are reporting. So they will report for their loan portion or for the total
Only
loan
their
portion?
loan portion.
Yes.
The ratio.
Yeah.
Actually,
so
the
on the principal and interest, because who calculates how is a problem. Principal is not a problem. Interest becomes a difficult.
Actually, the circular was issued when the IRAC norms was different for NBFCs and banks.
Right.
So that's why it was stated that each entity would report according to the IRAC classification. So both the banks and the NBFCs are required to report. That has not been changed. Now, of course, the IRAC norms are common for both NBFC and I think regulators should give a much more simpler guideline. Any one entity, ideally the bank which is maintaining the escrow account, can report.
But sir, in this practice, there will be a practical problem. The borrower is not aware that the two lenders have given the loan actually. Whenever this will be reported in civil, what will happen? There will be two names which will come maybe for the respective portions. So this might be a confusion later on actually.
So the thing has to be very transparent. So borrower should be aware. It is not that the thing is that borrower has to be made aware that this is a co-lending, under the co-lending model, he has been granted the loan. And the number two is that whatever said is right, but this problem will now not be there, because now if the account becomes an NPA in NBFC book, it will simultaneously become in bank's book also, because the norms are same for that. Earlier, this was a challenge. Yes, definitely it was a challenge.
So sir, one banker, they said they got the call.
That might still be a challenge, because the circular says it is akin to DA, but for direct assignment, we only report everything.
Yeah, I was coming to that. Actually, what practically happens is that there is some time lag between the actual disbursement to the customer and by the time the DA actually happens.
Right.
So in between there might be a reporting date which might fall. So initially NBFC might be reporting 100 rupee outstanding or sanctioned amount, and then it has to be corrected or revised retrospectively to 20 rupees. So I think banks are aware of it, and they are also agreeing for the total reporting to be done by NBFC in this sector.
Okay, otherwise, sir, there will be a big confusion in the. So I was talking to one senior banker. He said we got the call from the many customers that your bank name is coming in our civil. We have not taken loan from you. So they said we got many queries actually. This is a challenge which is coming actually.
In addition to that, Ashishji, what you are saying, the regulations also state that NBFC has to intimate to the customer about the co-lending model. But usually again in model 2, because it is akin to DA, so there is no such practice in DA. But however, there is still gray area whether that clause applies to model 2 or not regarding the intimation.
And from the customer perspective, see, credit bureaus scoring model normally work on number of lines and outstanding. So if some customer unfortunately took 5 loans, those will be reported as 10 and his score might go down. So there is no clarity on that. So customer is getting penalized without any reason.
And other than that, Mayanji, you see that customer in the model 2, generally you will send the message or maybe mail, which the customer is not practically seeing. Actually, you see the once the loan has been given to him, he's not bothering that. So he'll be surprised when the civil will be there in the 2 names. So actually,
I think the RBI prescription is very clear. What we have written is that the NBFC shall be the single point of interface for the customers and shall enter into a loan agreement with the borrower, which shall clearly contain the features of the arrangement and the roles and responsibilities of NBFCs and banks. So the agreement has to be very exhaustive and the borrower need to be made aware. But the question is that in practice, maybe it is not being done and the borrower is thinking that I've only availed from the NBFC.
Correct.
Sir,
So just to add
issues on the CLM2 side.
no, just to add on the CLM2, so practically in CLM2, you're required to send a proper letter to the customer, and the customer has to sign the letter with the acknowledgement. If you do not do that, it's a counter violation of the law. So you have to make it signed physically. It's an operational thing that all our branches have to do. And on the CIC issue, we had a very lengthy discussion with one of the CICs. And the CIC is already making a portal which will be live soon, where you will be reporting co-lending loans, where it will show on the loan format itself that it's a co-lender loan in that criteria. Jahan pe aapko loan dikhta hai, there only you'll be able to see it. So CICs are already working on it to make that difference because they also understand that challenge is happening.
that's true, sir. That's true. I think you have addressed the
But
right.
that might take time across all the 4 CICs.
Of course, it will definitely, but
So one might report as 1 loan, one might report as 2 loans. So that will be a much bigger. So customer complaint count will go up, nothing else.
It's another question which is asked by somebody. This is related to the views on co-lending models used as an alternative for FLDG structure. So people are just trying to understand this alternative of FLDG
is not
structure.
allowed, sir, in
Yes.
guidelines. Very, very clearly.
So
Yeah, so I think, and especially in the unsecured loan business, right? It is being more and more seen as an alternative because still now, all the, especially in the digital lending space, right? Between fintechs, whether they were regulated entities or not, and other regulated entities, whether they were NBFCs or banks, FLDG structures were the norm. Obviously, that caused its own set of systemic risk, etc. So I think co-lending is seen as a more kosher way of managing these partnerships and also ensuring that there is transparency in the risk, in provisioning for the risk that arises out of the portfolio, in the fact that both parties will have adequate skin in the game, and and that there is some distribution of risk to the originating partner also, so that throughout the period of the loan, they are, you can ensure that they will be doing what they were supposed to do. But I don't think, to your question, I think there is, the regulator is still going to come back as per the recent FAQs also, they're still going to come back with, very clear-cut guidelines on whether, how this will work in terms of some amount of securitization or if some amount of guarantees can be given even in these schemes, because otherwise, the whole point of the financial inclusion, solving the needs of the underbanked, underserved and all is going to take a big hit. Because like we discussed many times during all our conversations, there is a big difference in the underwriting or the risk appetite of banks or larger, NBFCs compared to the smaller digital fintechs and NBFCs who are actually addressing this segment.
Right, Soniaji, I think you have already covered this thing, but you see in the DA, the CLM2, it's akin to DA actually. And as per the RBI guidelines in DA, there should not be any credit comfort actually. So this might be, I think, clarified by RBI later on, and this co-lending it will be allowed or not allowed. But still, as of today, it is not clear that whether any bank can take FLDG on this co-lending model actually. And what I've seen, I have not seen any bank has asked for this also. Am I
Yes, I
true?
think there is a difference between how it works between a bank and an NBFC and between two NBFCs. But like I said, everybody is awaiting this, clarity from the regulator, given, especially after the new digital lending guidelines, especially in context of that. See, for your more secured loans, which are not digitally sourced and, which are smaller in number, larger ticket size, it works a little differently.
Correct. That's true actually. Then one more question is there, which is the last question which I'll take. That is related to the co-lending in the gold loan. Somebody asked whether the co-lending is possible in the gold loan. So anybody can take the answer this question.
I think it's not restricted, and I know one of the NBFCs, they are already running that kind of co-lending.
It's not restricted. It has to be only in the priority sector.
Right.
Okay.
But NBFC to NBFC, I don't think there should be a restriction.
So they can give gold loan for agriculture purposes, not for personal purposes, but for agriculture purposes.
But gold loan can be, how the gold loan can be for the priority sector, because most of the gold loans are for the consumption or the
agriculture. So up to 3 lakhs rupees agriculture gold loan, these are priority sector.
Okay, so that is covered in that.
For agriculture.
Or for MSME with them registration details.
Instead of KCC, they can take gold loans.
But there is no guidelines as such for NBFC to NBFC co-lending, I believe. There is still gray area because whether it is the same guidelines which has to be followed, or they can do whatever they want to do actually. This is another area which need to be addressed by the regulator. Because a lot of ambiguity there actually. Tomorrow,
I think again there is no restriction, but probably regulator might draw some inference from bank and NBFC co-lending regulation in case required.
Correct. That is important. It should come actually, because a lot of co-lending is happening between NBFC to NBFC also.
Actually, just to add from our personal experience on that NBFC to NBFC criteria, what the audience should be cautious about is if you're dealing with an NBFC or an HFC, which is a subsidiary of a bank, it's 100% subsidiary of a bank. It's a very tricky situation there. So that is somewhere the audience should take a legal opinion before entering into such agreements where it's a 100% subsidiary of a public or a private bank.
Okay.
Because we've done it. So that's why I'm giving it from our personal experience. It's not even a gray area. It's the black in the gray.
Okay. Right, sir. Thank you, sir. Thank you so much. I think we had a very good discussion today. A lot of interaction, a lot of insights, and I think a lot of knowledge sharing also. And I am really thankful to all the panelists, all the speakers who have contributed a lot. I think you all are people at the top in the organization, and you could find time for this webinar. Definitely, it's really a great privilege for us. I would like to thank you once again to all of you, each one of you, for your valuable time. And I would like to thank you to all the participants. More than 500 participants have joined across from the different channels. And I hope that they will be having more knowledge about the co-lending. Although we have used some technical terms, so there will be some people who will not be aware CLM1, CLM2, but because we are people who are practicing, so it's come without saying actually. But we are sorry for that if you are not in a position to understand some of the technical words. Next time we'll try to clarify these terms also. So thank you once again to everybody, and I'd like to thank you to the Resurgent India team, the people who are behind this show, Rohan, Javinder, or the Vishweshwar and other team members. Those have invited us and those have organized this program successfully. And thank you once again to all of you. And good evening, everybody. Thank you, sir. Thank you.
Thank you.
Thank you, Ashish.
Thank you.
Pleasure.
Bye-bye.